Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Now, that being said, once again, in order to construct this particular strategy, we're buying the 106 call option, and we're paying $1.61, and that's going to equate to $161. We're also going to be purchasing the 104 puts, and that's going to cost us $100. Now, ultimately, you can see here that once again, on expiration, if we decide to hold the position all the way out until the third Friday of the expiration month, and we're holding both sides, we will make money, provided that the pair value is trading below 101.39, or provided that it's trading above 108.61. Now, again, this seems, based on looking at this from a technical perspective, this seems like a long ways away, but understand that we do not have to hold this position for the entire duration. Remember earlier on we talked about the idea that we want to take advantage of that expansion in implied volatility, and so as implied volatility expands, as the underlying pair value moves in our favor, we may look to offset that position well before the expiration date, just so that we can capitalize on that expansion in volatility, and we don't run the risk of actually having to lose the entire premium on the opposite side. So again, there are many different ways that we can actually take advantage of managing these strategies throughout the life cycle. I see that there's just quite an extensive comment here from John, and I'm just going to maybe save reading it till the end, or else I'll be here for a little bit. So really appreciate any feedback or any comments that anybody has. I don't want to discourage anybody from it. It's just I'll take a couple of minutes when we finish up to have a look if that's okay, John. But once again, really appreciate the feedback. So what I want to do now here is just take a look at comparing the two strategies, just so that we can more or less compare apples to apples. You can see here that we were looking at the starting pair value being at 105, and the break-even point, of course, is based on our pair value at expiration. Now, the question just came up from Mike: is there any particular advantage to going further out than October with the options? Conceivably, Mike, it really depends on your outlook on the particular pair value. The bottom line is, when you look to extend your the time frame on these options, of course, it's going to cost you more, and your break-even point on the trade is going to be that much higher, because of course we have to add that the cost of the straddle or the strangle to the strike prices in order to make that determination. So yeah, you really want to just look at what your view is over a certain period of time. Typically, when we're looking at trading our directional view, we will go at least 2 to 3 months out, and basically our outlook is, it's either going to make a significant move this way or that way within that time frame, and we'll look to try to capitalize on that. Once again, if we're looking to trade a directional view over an extended period of time, well, we have success in fact, let's say we happen to be bullish on a particular pair value, as we were with the EUI. Well, what we ultimately did was we ended up going out and buying longer-term EUI call options, and we bought 2 of those for every 1 short-term EUI put option we purchased, which would be known as a ratio calendar straddle, which gets a little bit more complicated, but really it's just us manipulating the expiration dates and strike prices, as well as the ratio of the calls to puts, in order to trade a particular view. But all of that can be factored in and used to create a hybrid to the strategies that we're creating here. Sal, there may be a typo. I'm not sure where where you're looking at here, Sal. So I'll take a look at that. It was early yesterday morning when I was establishing that. So we're looking at the strangle here. Call on expiration with the okay, so let's just take a look at that. So basically let's just go through that, and we'll take a look at the strangle, and we'll move through the transactions here just to be clear. So first of all, with the straddle position, the 105 strike call, the 105 strike put, we paid $1.92 for the call. We paid $1.64 for the put. The net cost of that transaction was $3.56. The break-even points for both the call was 108.56, for the put was 101.44. Now remember, we're considering what are the values of these options on expiration. So the 105 strike call option on expiration, if the pair value is trading at 110, is going to be worth its intrinsic value. Okay, so ultimately we are looking at that call option being worth $5 because we take the strike, we take the price of the pair value, which is 110, and we subtract the 105 strike call, we have an intrinsic value of $5. That would be the cash settled value for that for that call option on expiration. Of course, the put option is going to expire worthless, leaving that net position with a value of $5. Well, of course, we paid for that combination $3.56, which means we've in fact profited $1.44 based on that particular move. Now, again, what I'm doing is I'm just trying to create a standardized approach to observing profit and loss on these positions. Assuming that the pair is at 110 on expiration, all you really have to do is just manipulate that the settlement value up or down, and substitute that in the equations here to determine what the pair value would be worth. It's a challenge, of course, throughout the life cycle of the option contract to establish what the profitability would be, simply because of the variation in the different market conditions that are influencing. But for here, we're talking about holding until expiration, and if we look at in the case of the straddle. So I'm just trying to observe here Sal's comment. So the call expiration on the strangle should have been 5. Well, remember that we bought a 106 strike call option. So this will probably help maybe answer your question, Sal. We did not buy 105. We bought 106. So we bought the higher strike. So we wanted to lower the cost of that call option, so we bought a 106 strike call option. You can see instead of paying $1.92, we paid $1.61. We bought the lower strike put option. In this case, we bought the 104 strike put. Now, the net cost of that transaction is $2.61, so we've almost lowered our cost basis by $1 by widening out these spreads and creating the strike prices and creating a strangle. You can see that our break-even points are really not that much far off. And so, in fact, what we've done is we've created a strategy where the break-even on the trade is not that far off from the straddle, but ultimately we've lowered our cost basis. So based on this outcome, seemingly the strangle would be a little better proposition. Now, if we talk about the call on expiration, and this will help answer your question, Sal, remember with the pair value trading at 110, we subtract the strike price, which is 106, and the intrinsic value on that 106 call option is going to be $4. We then need to take the $2.61 that we paid for that combination and subtract that from that call option value, and you can see that we in fact are up $2.39 on that particular position. So based on this particular outcome, if we wanted to compare apples to apples here, if we wanted to compare apples to apples here, what we've done by choosing the strangle over the straddle is we've lowered our cost basis and we've increased our percentage rate of return.
Visit www.fxoptions.com. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.